Income tax is a pay-as-you-go system, which means that you pay taxes as you earn. For employees, this comes in the form of income tax withholding on your paycheck, and for business owners and investors, this comes in the form of estimated tax payments. Today, we're going to be focusing on those of you who do not have sufficient paycheck withholdings to cover your entire income tax bill and thus have to make estimated tax payments. It's our recommendation that you make estimated tax payments to achieve your personal budgetary goals, and because if you don't, you'll be subject to underpayment penalties. Because underpayment penalties are tied to interest rates, we're in an environment where these penalties are going to be quite high. As of 2024, quarter one, the penalty is 8%, and you can compare that to 2023, where we started the year with only a 3% penalty. In order to avoid penalties, you can use one of two safe harbors. The first safe harbor is going to be based off of your prior year's tax return, and it's going to be making estimated tax payments equal to 100% of your prior year's tax. Or if your income's a little bit higher, like $150,000 or $75,000 married filing separate, then you have to use 110% of the prior year in order to fall under this safe harbor. As part of your 2023 tax return, if you had a requirement or if you owe taxes for that year, you're going to find vouchers. These vouchers are labeled 1040 ES for the federal vouchers and 540 ES for the state vouchers. And the vouchers that are included with your tax return by default assume that you're going to have the same level of income as the prior year and the same level of withholdings. But if any of those things change, then they might not be as relevant. The other safe harbor you can use is to pay 90% of the current year taxes in 4 installments. This is really good if your income's a lot different than it was last year, and it really helps avoid these penalties. Note that if you're in California and your AGI is over $1 million, you can only use this second safe harbor to avoid the penalties for California purposes. You cannot use the prior year safe harbor. Now, there are other rare circumstances where we can either avoid the penalty or waive the penalty. Like if your income all came in one quarter, we can annualize the requirements in order to lower the penalties or get rid of them completely. Sometimes we can request waivers. But this isn't a go-to. This is very rare circumstances where we would not use the safe harbor and we could use another method to avoid the penalties. So it's important to note the schedule by which you're expected to make these payments. First off, there's 4 quarterly payments. This year they're due April 15th, June 17th, September 16th, and then January 15th of 2025. The federal government expects the payments to be made in 4 equal installments, 1 for each quarter, so 25% each quarter. But California is a little bit different. They actually expect you to pay 30% of the taxes in the first quarter, 40% in the second quarter, and then they give you a breather in the third quarter with 0%, and then they expect the other 30% to be paid in January of the following year. And this is for individual tax purposes. This presentation was created to support our comprehensive tax planning service, where we curate strategies to assist taxpayers in reducing their tax liability. We do this by analyzing their business, real estate, and individual activities and determining the optimal structure, optimal accounting method, available tax deductions, and available tax credits. Then we prepare a summary of estimated tax savings and effect on global cash flow to assist our clients in determining which strategies to pursue. Finally, we coordinate the action items needed to actually achieve these savings. If you're interested in learning more, please schedule a call with us. Current clients, please reach out to your partner or accountant, and all others can call our office to schedule an intro call.